So, when things get messy on the world stage, what happens to crypto? Is it the new digital gold, a safe place to park your money? Or is it just another risky tech stock that everyone dumps at the first sign of trouble? It's a huge question, right? Well, today, we're going to follow the money and see what the data actually tells us.
All right, let's kick things off with a little thought experiment. Picture this. It's a Saturday. You're relaxing, but halfway across the world, some major geopolitical crisis breaks out. Now think about it. The stock markets? They're closed. Bond markets? Closed for the weekend. So, what market is the very first to react to price in all that new risk? Well, it's the one that never, ever sleeps, the global crypto market. And you know, that one simple fact, it changes everything about how crypto behaves in a crisis. Right. So because these markets are always on, 24/7, they kind of become the financial world's first responders. When a crisis hits, boom, they're the first ones to show us what the fear and uncertainty looks like in real time long before the suits on Wall Street have even had their Monday morning coffee. I mean, just think about it for a second. While traders for, say, the New York Stock Exchange are waiting for that opening bell on Monday morning, crypto traders have already been at it for a full 48 hours, maybe more. It's what makes crypto this incredible live fire barometer of how investors are feeling around the globe.
And you know, that initial reaction, it's almost always the same thing. It's what we call a risk-off liquidation. See, if there's one thing markets hate more than bad news, it's uncertainty. So when a crisis kicks off, the gut instinct is just to sell the volatile stuff first and ask questions later. Run for the perceived safety of cash or gold. And for a lot of the big funds out there, crypto is sitting right at the very top of that sell-first list.
But here's the thing. That initial panic sell-off, that's not the whole story. Not by a long shot. What's really fascinating is what happens after that initial shock. Because in crypto, a conflict can totally reshape the story. It can create these brand new narratives about what this technology is even for. A perfect example of this is the invasion of Ukraine back in 2022. The first reaction was totally textbook. Bitcoin tanked. But then, something really interesting happened. Just days later, it surged right back up, even past its pre-invasion price. So what gives? What changed? The story changed. All of a sudden, Bitcoin wasn't just some speculative asset anymore. No, it was a lifeline. It was a tool for refugees, for people who were suddenly cut off from the global financial system. It was this huge proof of concept moment that showed, hey, in a crisis, the actual usefulness of this thing could be way more important than its price swings. And this quote from Brave New Coin just nails it. The whole idea of crypto as this censorship-resistant, borderless money suddenly came into razor-sharp focus. Its purpose, its actual utility became more important than its crazy price swings. And that right there perfectly illustrates this massive tension at the very heart of crypto today. I kind of think of it as the digital gold identity crisis. Is Bitcoin a safe haven like gold, or is it just another speculative tech asset?
So on one side of the coin, you've got the digital gold story. It's decentralized, nobody can just seize it. It could maybe even protect you if your country's currency goes down the drain. But then, on the other side, its price chart often looks exactly like a high-risk tech stock. It's super volatile, and when the whole market panics, Bitcoin tends to get dumped right along with everything else.
So, which one is it really? When push comes to shove, which identity wins out? The story or the actual market behavior? Well, you know what? Let's stop guessing and just look at the hard numbers. The data on how the big money is actually treating Bitcoin, well, it's pretty revealing. Okay, first up, let's look at how it moves with tech stocks. Recently, Bitcoin's correlation with the Nasdaq hit 0.75. Now, to put that in perspective, a score of 1 would mean they move in perfect lockstep. So, yeah, 0.75 is incredibly high. It basically means that when tech stocks go up, Bitcoin tends to go up. And when they fall, Bitcoin falls right there with them. Now let's compare that to gold, right? The classic safe haven asset. The correlation there, get this, -0.27. That means that lately, Bitcoin has actually been moving in the opposite direction of gold. So when investors were running to the safety of gold, a lot of them were selling Bitcoin to do it.
So here's the bottom line on that. Despite this really powerful digital gold story, the big institutional players, the big money, they're treating Bitcoin as commodified risk. In their complex models, it's basically a high-beta tech stock, which is just a fancy way of saying it's extra volatile. It's not a safe haven. When a crisis hits, their playbook is to sell it and buy good old-fashioned physical gold.
But wait, what if we zoom out a bit? I mean, that initial gut reaction is one thing, but what's the long-term impact of all this geopolitical risk? Well, some academic research actually gives us a much more nuanced picture.
Okay, I know this chart looks a little complicated at first glance, but the story it's telling is actually pretty simple. It comes from a research paper that modeled how precious metals, that's the blue line you see, and Bitcoin, the orange line, react to a sudden shock of geopolitical risk over a full 12-month period.
But look closely at the timing. See how precious metals, the blue line, they spike almost immediately? That's your classic flight to safety. Bitcoin's reaction, on the other hand, is a lot slower, more gradual. But here's the key insight. Over the long run, both of them end up higher than they were before the crisis. This suggests that even though they behave differently at first, sustained geopolitical risk actually acts as a long-term tailwind for both assets. Bitcoin just takes a different path to get there.
So, with this complex reality in mind, where it acts like a risky stock in the short term, but maybe a safe haven in the long term, how should you actually think about crypto when the world feels like it's on edge?
Well, this brings us to a sort of practical playbook. First off, diversify. It's the oldest rule in the book for a reason, right? Don't put all your eggs in one crypto basket. Spreading your holdings around can really soften the blow. Second, think about preserving your capital. This might mean swapping some of your more volatile coins into stable coins, the ones pegged to the US dollar, just to sidestep that initial chaos. And third, and this is a big one, secure your assets. Get them off the exchanges and into a cold storage wallet. That's a physical device, totally disconnected from the internet. It gives you complete control, even if an exchange has problems or goes down.
And this might be the most important takeaway from all of this. Crises are emotional, chaotic.